All right, let's dive right in. Today, we're talking about a concept that's absolutely critical if you want to understand how a company is building its future: capital expenditure, or what you'll hear called CapEx. We're going to break this down just like a top-tier consultant would, giving you a framework to see past the noise and really get what a company is betting on for tomorrow.
You know, it all boils down to this one simple question. How do great companies actually invest in their own future? I mean, it's not just about the stuff they're selling today, right? It's about the foundation they're laying down for years and years to come. And the answer, at least in the world of finance, is right there in their CapEx. This isn't just some boring line on a spreadsheet. It's a company's ambition made real.
So here's our game plan to get to the bottom of this. First, we'll nail down the core concept of CapEx. Then we'll tackle the big one, the difference between CapEx and OpEx, because that trips a lot of people up. After that, we'll get into the nitty-gritty of how you actually find and calculate it. But the real power comes from the analysis, so we'll show you how to pull out some key insights. And finally, we'll wrap it all up with the investor's bottom line.
Okay, let's start at the beginning, the fundamentals. What exactly is capital expenditure? It sounds a little intimidating, but I promise you, the core idea is actually super straightforward.
Simply put, CapEx is the money a company spends on big, physical things that are going to last for more than a year. We're talking about things like building a brand new factory, buying a whole fleet of trucks, or upgrading a massive server farm. These are the huge, foundational investments that are designed to make the company bigger, better, or way more efficient down the road.
And here is a really crucial point. A capital expenditure is not treated like your everyday costs. It doesn't just show up on the income statement and disappear. Instead, it gets capitalized, which is just a fancy way of saying it's recorded as an asset on the company's balance sheet. Then, the cost gets slowly written off over the asset's useful life. We call that depreciation. This just makes more sense, right? A new factory provides value for decades, not just for one quarter.
And to make this really tangible, think about these kinds of things. For a car company, it's the new robots on the assembly line. For a tech giant, it's the millions they spend on servers to power the cloud. It can even be things you can't touch, like patents, that give them an edge for a long time. Every single one of these is a bet on the future. It's the company's growth strategy in physical form.
Now, to really get a handle on CapEx, you have to see it next to its counterpart. And honestly, the single most common point of confusion is the difference between capital expenses and operating expenses, or OpEx. Nailing this distinction is absolutely fundamental.
This chart lays it out perfectly. Look, think of it this way. Buying a house, that's a capital expenditure. It's a huge, long-term asset you'll use for years. But the monthly utility bills, the electricity, the water, those are operating expenses. They're just the day-to-day costs of using the house. So CapEx builds the foundation, OpEx keeps the lights on. And notice how they're treated differently for accounting and taxes. OpEx gets deducted right away, while CapEx is deducted slowly, bit by bit over time.
Okay, so we've got the concept down. Now for the fun part. How do we actually find this number? Let's roll up our sleeves and get into the mechanics of digging up and calculating CapEx from a company's financial reports.
The most direct way, the easy button, is to just look at the cash flow statement. It's usually sitting right there in the cash flow from investing activities section. You might see it called purchases of property, plant, and equipment, or capital spending, something like that. This is the company telling you, straight up, how much cash they spent on these big long-term assets.
But what if it's not spelled out for you? No problem at all. We can figure it out ourselves. First, you're going to grab the depreciation expense for the period. Second, you find the value of the company's property, plant, and equipment, or PP&E, which is just all their physical stuff, from the balance sheet for this year and last year. Third, you calculate the change between the 2 years. And finally, you add this period's depreciation to that change in PP&E.
So this formula wraps that all up nicely for us. CapEx is just the change in PP&E plus the current depreciation. Now you're probably asking, why in the world do we add back depreciation? Well, it's because depreciation is a non-cash charge. It's just an accounting entry that lowers the value of assets on paper. No actual money leaves the building. So by adding it back, we're basically canceling out that accounting entry to figure out how much actual cash the company spent on new stuff.
And now we get to the most important part. We have the number. So what? I mean, who cares? The real value isn't just finding the CapEx number, it's knowing how to use it to generate some seriously powerful insights about a company's strategy and its financial health.
This is the million-dollar question, right? You see a company spending billions and billions on CapEx. What does that even mean? Is it a sign that they're growing like crazy and are super confident? Or is it a sign of reckless spending on projects that are going to be a total bust? The truth is, the number by itself is pretty much meaningless without some context.
So, to get that context, we use a diagnostic tool, the cash flow to CapEx ratio. This little ratio is incredibly powerful. It compares the cash a company makes from its main business to the amount it's spending on these big investments. It answers the one question that really matters: can this company actually afford its own growth plans?
And the magic number here is 1.0. If the ratio is greater than 1, it means the company's daily operations are generating more than enough cash to pay for all of its investments. That is a huge sign of financial strength. But, and this is a big but, context is king. For a big old industrial company, a ratio below 1 could be a massive red flag. It might mean they're borrowing money just to stay afloat. But for a tiny high-growth startup, a low ratio might be totally fine because they're using investor money to expand like crazy. The story is in the number, not just the number itself.
Let's make this real with an example. We've got two companies here. ABC Company is a giant. Massive cash flow, massive CapEx. Then there's XYZ Corporation, which is smaller on both counts. Now, at first glance, you might think ABC is the stronger, more ambitious company, right? But let's run the numbers and see what story really emerges.
And wow, the results are pretty eye-opening. ABC Company's ratio is 1.94. That's healthy. They're generating almost $2 in cash for every $1 they invest. But look at XYZ Corporation. Its ratio is a staggering 5.49. For every single dollar they spend on CapEx, they're cranking out nearly $5.50 in cash. This tells you that XYZ is an incredibly efficient company with just enormous financial flexibility. It means they could go buy a competitor, or pour money into R&D, or give more cash back to shareholders, all without breaking a sweat.
Okay, let's bring this all home and focus on the bottom line. From the perspective of an investor or a strategist, what is the single most important thing you need to remember about all of this?
This quote from our source material really just says it all, doesn't it? CapEx is the clearest signal you're going to get about how much a company is investing to either just keep the lights on or, much more importantly, to grow. It's what separates the companies that are just coasting from the ones that are actively building for the future.
So, let's recap our briefing. First, CapEx is all about investing in the long-term physical future of a business. Second, remember it lives on the balance sheet as an asset. It's not an immediate expense. Third, the real insight comes from that CF to CapEx ratio, which tells you if a company can pay for its own growth. And finally, a ratio over 1 is a really powerful sign of strong financial health and self-sufficiency.
So I'll leave you with this one final thought. The next time you're looking at a company's financial statements, ask yourself this question. Are you just seeing the costs of running the business today? Or are you using the lens of CapEx to see the strategic investments it's making for all of its tomorrows? Because understanding that difference, well, that's what separates a quick glance from a true, deep analysis.